U.S. natural gas futures powered higher for a third straight session on Friday, with September contracts springing off that crucial $2.80 support. Midweek momentum carried prices right through resistance at $2.95, a breakout that had traders on edge, before pulling back to close near the highs. All this comes at the end of a wild week, where shifting weather forecasts, fresh supply data, and rig counts clashed with powerful technical signals, leaving the market on the verge of its next big move. Domestic demand remains underwhelming by comparison. Consumption on Friday came in at 80.3 billion cubic feet per day, just 1.2% higher than last year. LNG exports provided firmer support, jumping 4.8% week over week to 15.7 billion cubic feet per day, but even strong overseas flows can't fully absorb the relentless surge in U.S. supply. The EIA recently lifted its 2025 production outlook by 0.5% to 106.4 billion cubic feet daily and nudged its 2026 forecast higher by 0.7% to 106.1 billion cubic feet per day. On Friday, dry gas output surged to 109.9 billion cubic feet daily, up 7.3% year over year and hovering near record highs, underscoring the market's long-term supply overhang. Short-term, however, the weather gave bulls a glimmer of hope. Atmospheric forecast flagged a warming trend across the western U.S. for August 20th to 24th, even as the east remained cooler. This split outlook helped spark a modest rebound after Wednesday's 9-month low, though bearish supply pressures continue to cap any meaningful upside. In the latest storage report for August 2nd to 8th, the EIA said inventories were up by 56 billion cubic feet. That came in line with market expectations but was still about 23 billion cubic feet higher than the 5-year average, which leans bearish. With that build, storage now stands at 3,186 billion cubic feet, pushing the surplus versus the 5-year norm to 196 billion cubic feet. Year over year, the deficit has narrowed to only 79 billion cubic feet. What really stands out here is that injections so far this season, through the first 19 weeks, are the largest we have seen in at least 5 years. They have even surpassed 2020, back when prices were stuck below $2.50. Yet today, prices are holding much higher. The main reason is that traders are counting on stronger demand from LNG exports. The issue is that storage continues to climb, which does not match the bullish story. Right now the market is betting on nearly 2 billion cubic feet per day of new LNG export capacity from Plaquemines and Golden Pass, which are expected to start ramping up by the end of the year. Until that happens, the rising inventories are hard to ignore. From a fundamental standpoint, the only real driver that could push natural gas prices meaningfully higher would be a colder than expected start to winter, likely sometime in December or January. Without that weather support, the market is struggling to justify current price levels. Record high production has already absorbed much of the additional demand created by rising LNG exports, leaving the supply-demand balance tilted heavily toward oversupply. In other words, unless we see an early and intense cold snap that materially boosts heating demand, there is little justification for prices to remain above the $3 mark. Technically, the market is vulnerable to renewed downside pressure, as strong production growth continues to outpace the incremental demand gains that traders have been counting on. On top of that, the recently concluded US-Russia summit has sparked speculation that the Russia-Ukraine conflict could be approaching an end in the coming months. If that scenario plays out, it raises the possibility of Russian gas flows to Europe being at least partially restored. Such a shift would represent a major change in Europe's supply picture and could unleash significant bearish pressure on global gas prices. At the same time, there are circulating rumors that Putin and Trump may have struck a deal allowing American companies to re-enter the massive Sakhalin-1 LNG project. If confirmed, this would be another game-changer, potentially flooding additional supply into the Asian market and adding yet another layer of bearish weight on regional gas pricing dynamics. So the EIA's forecast for elevated prices this winter could end up failing once again, unless we get an exceptionally cold season to drive demand higher. Right now, the market is sitting at a real pivot point. If natural gas can hold it close above $2.95, it could open the door for a run toward $3.15 with the 50-day moving average at $3.33 as a key target to watch. But if prices can't stay above $2.77, we could quickly see it drop back toward long-term support at $2.65. In the short term, momentum is leaning bullish, so there's some reason for optimism. The problem is that supply is still hanging over the market. Production is near record highs, storage keeps climbing, and any rally could easily run into strong downward pressure from these factors. So even if the charts look promising, the fundamentals are ready to push back hard if prices get too far ahead. Don't forget to like, drop a comment and check out the previous video to help support the channel, and see you in the next one.